Good morning, everyone. Or good afternoon, as the case may be. This is John Kogan. I'm the CEO of Performative, the online community and resource for corporate finance, treasury, and accounting professionals. We're very happy to have everyone here with us today for today's webinar. We have a lot of content to cover in the coming 90 minutes. And today we're going to be covering a number of critical issues for companies that are interested in executing or thinking about, in any way, M&A globally. The Eurozone debt crisis has dampened markets globally, but boards continue to expect growth. 60% of companies are blaming currencies for revenue misses and reduced forecasts this quarter. Emerging markets led by Asia and Latin America represent the greatest opportunity for growth, and M&A is still a key strategy to leverage. In fact, the majority of Fortune 2000 companies are driving top-line growth through international expansion. However, while attractive, this strategy increases currency risk and operational complexity. Today's webinar will share best practices for addressing M&A currency challenges using real-world case studies, and will offer answers to big questions around effectively managing M&A currency risk. I'm very happy to have with us today a wonderful crew of folks who will be walking us through current events and currency fluctuations and all sorts of ins and outs and best practices around managing currency in the world of M&A for finance, accounting, and treasury professionals. We'll get to their introductions in just a moment. A couple of notes about today's event to get us started. Number one, a link to today's presentation and a link to the video, which will include the audio of this webinar, will be sent out to all attendees within 24 hours of the event. And in fact, is already posted at performative.com/resources. So those who want to follow along, take notes, etc., you can grab that right now. It's free and it's available for download. Next up, we have a number of folks on today who will be receiving CPE credits. If you are a CPA, you will need to answer all of the 3 polling questions that we will present today. They will come sort of beginning, middle, and towards the end of today's presentations, but they're actually statistical in nature, and we would appreciate if everyone would join in and take the 20 seconds to answer these polling questions. And we'll actually, if we have time this afternoon, we'll share the results of the polling questions with the folks so you can see where you stand relative to everyone else on the call. Next, please do ask questions during today's webinar. If you glance briefly at the GoToWebinar control panel, you'll see there's a little section there entitled Questions. Please do ask questions as we go. Now, we will hold questions until we get to the Q&A portion of the event, which will come toward the end. We'll do our best to get all the questions in, and if we don't get your question in, we'll certainly work with today's speakers and presenters in order to follow up and get your questions answered to the best of our ability. But please feel free to ask them at any time. Finally, when you step off of today's webinar or when we shut it down, whichever comes first, you will be asked to take a short survey. It's very brief, about 60 seconds. We greatly appreciate your feedback. It allows us to do better every time we have another webinar, and we do quite a few of these. We also make it very simple to request connections with any of today's speakers. So if you would like to connect with any of today's speakers, just make sure you check their names off when you get to that survey, and we will be more than happy to directly introduce you. Next up, a quick welcome to Performative. We are the largest online community for corporate finance and related professionals, and it's all business on Performative. It's all peer-to-peer and subject matter expert exchange of information, and we're happy to have you on board. It's entirely free and ad-free, no self-promotion, none of that. It's just peers helping peers learn and get work done. It's a great thing, and we welcome you. We have a number of learning objectives this morning that I'll let you read through there very briefly. But at the end of this, we will all be far smarter about the impact on M&A of currency issues. And we will have best practices under our belt. We'll have a lot of real-world examples under our belt. And in order to get us started down that path, I'd like to start with a quick run-through of today's agenda, and then we'll get right into our first speaker. So at the start today, we'll be looking at market drivers for M&A in the corporate sector. So where's the activity? What's driving it? Next, we will move into tips and techniques for currency-aware M&A, from pre-acquisition through integration and as part of your ongoing business strategy, and then we'll get to the Q&A at the end. And leading off for us today, it's my pleasure to introduce Andy Gage. Andy is Vice President of Strategic Market Development at FireApps. Andy has over 20 years of experience in FX exposure management, business process reengineering, lean manufacturing, and ERP system deployments. In his role at FireApps, Andy advises corporations, consulting firms, and business partners on a wide range of exposure management topics and industry best practices. Andy has previously held senior management roles at Deloitte Consulting and Syntex Pharmaceuticals and is a frequent speaker at Treasury and Finance conferences. And with that, Andy, please take it away.
Thanks. I appreciate the introduction, John, and welcome everybody to the session. This is a session I've personally been looking forward to for quite a while because it is something that we run into fairly regularly with our clients as companies are dealing with the appetite for growth, and we've certainly seen a lot of interesting challenges that come out of the M&A process related to currency risk. So I hope you find today's session very informative. To set the stage for that, I don't think we need to spend a whole lot of time on just taking a step back and looking at the impact that currencies are having across the board. We've seen a noticeable uptick, and this really started back with the financial crisis in 2009. Some very significant currency volatility, very strong directional movements, and last quarter I think was particularly challenging for a lot of corporations. We actually did a study of the earnings calls of about 650 corporations for the past several quarters, and we detected with the dollar going from about 135 to 125, there was a 50% increase in analyst questions about the impact of currencies on financial results. So it's certainly a focal point for corporations right now, and given what's happening in Europe and in other parts of the world, it's going to remain so. So given that, we also, as a course of operations, we monitor what CEOs are talking about in terms of the directions that they're taking their companies. And we've seen a significant uptick, really starting back in 2010, with companies really trying to get back on top of the business opportunity and start to drive top-end growth as they've climbed out of the recession. And as you can make a direct correlation, there's been a strong appetite to build those businesses into emerging markets. And one of the challenges that we see represented by that is, as we've been working with our client base, is that the way in which companies are moving into these markets oftentimes is through bolt-on or tuck-in acquisitions, where they're building out their ability to access markets in Latin America, in the BRIC countries, in Asia-Pac, and they're gaining access to those markets through very quick acquisitions. But that does add a tremendous amount of complexity to the challenges that currency risk managers have to deal with inside of corporations. When you then take a step back and think about that in the light of the euro threat, obviously there's been a tremendous amount of news this week with the German courts basically upholding the rescue package. There's been now the impact of quantitative easing here in the U.S. Adding to that volatility, but I don't think anybody at this point feels that we're out of the woods yet. There's still a number of issues that need to be dealt with systematically within the Eurozone, and there is an increased call that and preparation, quite frankly, for Greece to separate from the euro. Now, whether or not you subscribe to that belief is actually somewhat secondary if you're a currency risk manager. I think the main thing that we expect to come out of this is a significant increase in volatility. And I think anybody on the panel today would bear witness to that. And we see a lot of companies working very hard right now to prepare as they go into the next year, thinking about the potential scenarios. And there's a lot more questions being placed on Treasury and the FP&A group coming in from boards, CEOs, from CFOs around what is our exposure and how is the euro potentially going to impact my P&L and my cash flows and my earnings per share. And in many cases, just due to the way that companies approach talking about that question historically, they're not very well equipped to deal with that. So there's been a real urgency to begin thinking about that in more substantive and quantitative terms. But that's really kind of the backdrop that we see from what's driving a lot of activity is that appetite for growth. There's a lot of acquisitions that are happening out of there. There may not be the large grain acquisitions like you saw a few years ago with the Mertz buying the shearing plows and Pfizer buying Wyatt, but there's a lot of incremental acquisitions that are going on right now to fund or drive that international growth. And I think as you get to see how the Avnet businesses continue to expand, they're very much along those lines as well. So with that, what we'd like to do now is step into a quick polling question. John, if you want to take that over.
Yep, well, let me grab that. I'm going to go ahead and launch our first polling question right now. We're going to give folks about a minute here to work their way through that. And once again, even if you're not here for CPE credit, we would certainly want you to take this poll, and we'll take a look at how everyone answers when we get to the end of today's event. I'll also remind you that you can ask questions at any time, and please feel free to do so via the control panel and your the question portion of your GoToWebinar control panel. We'll leave this out for another 10 seconds or so, and then we will hand over to our next speaker.
Can I type it in here?
Okay. So at this point, I'm going to go ahead and close down that poll and introduce you to our next speaker. Corey Edens, who is the Chief Operating Officer of FireApps. Corey is the Chief Solutions Officer and co-founder of FireApps. In this role, he oversees the company's product and solution strategy and assists clients in designing and implementing holistic currency risk management programs. Prior to beginning this role in 2000, Corey served in numerous executive finance and accounting roles, including his role as president of Valcon Distributing Limited and controller and director of operations for the Microsoft Network. Corey holds a BS degree with high honors in accounting from the University of Montana. He's a trustee of the University of Montana Foundation and a board member of ACI America, the Financial Markets Association. He has been published in the Journal of Corporate Treasury Management and is a frequent speaker at university and industry events. And with that, Corey, please take us away.
Well, thanks, John. And the area we're going to cover today, the area that I'd like to speak about is pre-merger FX readiness, and some key to success and things that I've seen in working with companies over the last 10 years. Key point to start with is ensure that Treasury is at the table with their FX lens. And it's, as you're sitting there, you're thinking about the impact from pre-close planning through the process of moving towards the close and then post-close. And being able to visualize, what that could potentially look like. Driven at, driving an awareness as to what is happening. And the goal at the end of the day is to eliminate FX surprises. So some of the key areas as you begin to think and work your way through that with that lens is being able to think about total exposures and the risk associated with those exposures. You have that risk and those exposures today in your world prior to the acquisition or merger, and now you'll be accumulating or incorporating potentially additional exposures in some of the same currency pairs and sometimes another currency pairs, in other areas of the world that you haven't done business in before. And then along with that is thinking that through is then it's the FX risk management framework that you have in place to manage your exposures today, and what does that need to look like going forward? Is it robust enough? Do there need to be significant changes to it? Is it ready to go? And then as you begin to work your way through the moving towards the close, it's thinking about, is the acquisition going to be done with existing funds in the organization, the enterprise today? Or will there be repatriation of funds or intercompany loans moving funds back to corporate, or potentially a multi-currency financing tranche or line that will be utilized for meeting the funding needs of the acquisition? So there it is, just being aware of the business transactions that could affect the current exposures as you move your way towards the close. You just want to be in a position to synchronize any needed risk management actions with business transactions or financing transactions that are getting you ready to close, so that you properly limit that risk. And then many times it's the Treasury and finance teams work closely with tax and looking at the actions that they may ready the firm for in getting ready for close, and is there anything there that needs to be orchestrated with regard to current exposure or potential future exposure as you look at that. Then corporate organizational structures. How does your Treasury team and your process look, and what's coming at you? Are you centralized or decentralized today, and is the world that, or the company that you're acquiring or merging with, do they have a process in place today? Are they centralized? Are they decentralized? How do you think through that, that merger of those worlds into an effective risk management program? And then it's being aware of source systems, the source system landscape, where that exposure resides in the enterprise. Is the data from the merger, or the customer or the company being merged or acquired, is that data going to be migrated into your existing ERP system so that you have to be ready there? Or are they going to leave the acquired ERPs in place and are those eventually going to be migrated? So just thinking through all of those, the system-related pieces, being able to get at that exposure. And as you can see, each of those points above, it's cross-functional. It's important to think your way through those things and visualize through that. But at the end of the day, it's important to develop a detailed action plan to manage FX risk or potential FX risk as these business transactions are occurring throughout the M&A transaction life cycle. So basically, project manage it. You plan your work, work your plan, the basics of project management as you work your way through. Key point here, though, is remember, at the minute the acquisition closes, you own all of the exposure. So you need to be ready to manage it with that new FX risk starting day one. So with that as a backdrop, I'd like to go through a quick case study of a company that worked their way through, what we just talked about, being ready, working their way through each of the prospective issues as they were going through an acquisition process, and that's JDA Software, a supply chain solution software company that with about approximately $700 million in revenues. But as you can see, there's 6,000 employees operating in 60 countries with a large customer base. In 2006, they acquired Manugistics, and it was a marriage of similar-sized companies. And so with that backdrop of what we talked about, the JDA Finance team used a very disciplined approach to repatriate and convert excess cash from across the enterprise to ready for that acquisition. They looked at some intercompany loans and dividend payments. So as they were working on the financing strategy, they were building this 4-point financing plan. So they were looking at the projected operating needs of the foreign subsidiaries. They were looking at the repatriated funds and the loans that were being put in place, and identifying what the FX impact would be as they were thinking through each of those actions, so that they could look at the optimal flows for bringing those back to corporate. At the same time, while encompassing a FX strategy to support those actions. Again, harmonizing that, being synchronized, so nothing was out of step. So if a risk or an FX exposure was changed, the risk mitigating action was accomplished at the same time. So they did all of this analysis with the platform or the framework of their FX management program in place, so they could see what existing was happening. They could introduce the potential changes, take a look at what the effect could be, and take the appropriate actions. So with that in mind, we are at the panel discussion, and so I'll pass this back to Andy.
Yeah, thank you, Corey. I think it's a great illustration with JDA's working through that acquisition process, and I think one of the things that'd be interesting is at the end of the day, how did that affect the financing? Were they able to really achieve a significant improvement in lowering their transaction costs as a result of that execution?
Yes, they were, Andy.
Okay, great. So what we'd like to cover now is we're going to work through a variety of topics here very quickly, just to get some feedback and input from the panel here. I know I want to make sure that Mike, were you able to jump on the call? You're connected now?
I'm on, yes.
Excellent. So Mike, I know you've got some very strong insights into some of the things that people need to be concerned about as they structure the transactions and the potential hedging. Why don't you share a few of your thoughts on just managing the actual transaction risk with the FX exposure with an acquisition? I know, Joe, you've got an orientation based on your process, so perhaps you could follow in on Mike's comments.
Sure, Andy, thank you. Yeah, we've been involved in a lot of merger and acquisition transactions, and as we've discussed with the beginning portion of this this webinar, and we'll continue to cover throughout the remainder, you really need to break it into three components, and that's the pre-acquisition planning, the kind of the day one acquisition integration activities, and finally the post-acquisition ongoing management of FX and Treasury-related activities. Through our own experience, we've seen that the largest focus around kind of the pre-acquisition preparation falls into really two components. One is if it is in fact a purchase or a deal that is being transacted in a non-functional currency, obviously there are several components of risk that come into play that you have to factor in to your strategy. For instance, we've worked with a few companies that were either buying companies in euro or buying companies in Canadian dollar, US-based companies. And they needed not only to figure out how do they hedge their exposure for that transaction, but what is the optimal way to ensure that changes in the transaction that might occur between the time you're entering discussions and the time the deal actually closes don't leave you in an awkward position should something change with the transaction. In one deal in particular, I'm thinking of a Canadian deal acquisition or a Canadian dollar acquisition. There was a lot of probability that the deal would close, but quite frankly, it wasn't 100%. So as this company had to think through the strategies around hedging the Canadian exposure, they couldn't simply put a forward in place and assume the deal would close because there were all sorts of possibilities that might arise prior to closing and leave them with a naked exposure. So we actually had to start looking at other strategies, including some options-based approaches and ultimately looking at deal contingent strategies as well. So the real takeaway on that is you need to put a lot of thought into exactly what the risks are associated with the closing of the transaction and factor in a strategy that protects you in all situations. Now, obviously, post-close and on day one of the close, you have a whole different set of concerns, and that's around managing the day-in, day-out exposures that new segment of business brings into play. So all of a sudden, you're doing business with a completely different set of currencies, potentially, a completely different set of processes and personnel. And as we get into some of the day one considerations, we'll touch on the types of things that you need to factor in as you're working through those details.
So Joe, I'm going to turn it over to you because I know that this is something that you guys look at and may take a slightly different approach, or maybe you could just share your thoughts on that. And then Corey, just to give you a heads up, I'm going to ask you to comment on some of the challenges that come along with handling the embedded translation that can come out when a company's actually divesting, and then that potentially impacting the cost of the acquisition for the other side. But let's start with Joe.
Yes, this is Joe Burke at Avnet. Avnet takes a fairly simplified approach regarding managing the risk of a imminent acquisition. Typically, we have a pretty short time frame between the signing of a sales purchase agreement and the closing. Due to a number of reasons, we generally tend not to be hedging an anticipated transaction for a number of reasons. One of them has to do with the accounting over quarter end and things like that. Many of our transactions are in U.S. dollars. Many of our transactions, if they're not in U.S. dollars, they might be the purchaser for the Avnet side might be a holding company in Europe that's purchasing in euros. So I think over the years we've developed ways in which the acquiring entity of Avnet is more or less lined up with the currency that we're acquiring the target in, and therefore we have not really had a lot of impact from foreign currency risk. But I would say the key takeaways, I'd echo what Mike said, and that is, it starts with the sales purchase agreement. Know who the acquiring company is within your organization, what's their functional currency, and what is the currency of the purchase in, and that'll dictate where you go from there as to whether you want to hedge that transaction or not. You have to go into it understanding not only the economic situation, but the accounting aspects also.
Thanks, Joe. And Corey, maybe you could just talk about the embedded translation cost that can sometimes bite a company.
Yes, and a lot of times I've seen this in a couple different cases where companies have, they've acquired or merged with another organization, and as they begin to work their way through the entity structure and the duplication, and they begin to think about divesting some of those entities or those companies, there may be some embedded translation risk that's sitting down there, or a risk that they'll have a realized P&L impact or realized loss associated with the divesting of some of those companies. I was aware of a company, worked with a company that as they worked their way through this, they ended up with it was a $90 or $95 million loss, realized loss that came through as they sold this company that they hadn't thought of or hadn't been aware of as they worked their way through the transaction. So I think it goes back to that readiness and pre-close readiness, is just be aware of the potential implications of those things post-close as you work your way through the entity structure.
Thank you, Corey. I think we're ready to transition into the next section. And John, I believe we've got a quick polling question before we jump into Mike's section.
We sure do. Thanks for that segue. So we do have a very quick polling question, and this is all anonymized, by the way, folks. So no one will know that you in particular are answering this at your company, but interested in seeing how many folks are looking at an international acquisition in the next 12 to 18 months. Once again, even if you're not here for CPE credit, we would love for you to chime in here, and then we'll take a look at the aggregated results when we get to the end of the presentations today. We're going to give about 5 more seconds here to let the last few folks get their votes in. Another quick reminder, please feel free to ask questions as we go, and we'll get to that during the Q&A period at the end of the webinar. Okay, I'm going to go ahead and close that down and introduce our next speaker. We actually have 2 folks who will be talking during this section. The one that we have not introduced yet is Mike Ellis. He's a partner at Treasury Strategies, and as a partner of Treasury Strategies, Mike leads the firm's corporate practice area, providing consulting support to organizations in both the public and private sectors. He helps clients strengthen their Treasury infrastructure and operations through the deployment of best practices. Mike has more than 28 years experience in Treasury and consulting and has held senior Treasury roles in 4 different industries. Mike received his MBA from Roosevelt University following a BS from Eastern Illinois University. He is a certified Treasury professional and a CPA. Mike, welcome again. I know we already heard from you, but please take it away.
Thank you. I appreciate that. Well, as you see from this slide, it's very important that you look at the acquisition from the standpoint of project management planning, as one of the earlier speakers had mentioned. It's kind of like building a house, if you think about it. You're envisioning constructing your dream house. Well, obviously, it's much better to carefully consider the design, the structural components of that house, the cosmetic improvements that you ultimately need to make as you're moving into the new house before you actually are in and basically kind of I guess constrained by limitations of being in that house. The acquisition process is very much the same way. As you are planning the acquisition, as you're entering into the initial discussions with the acquiring target, there are a lot of components that you want to consider from the standpoint of FX. Now, I've broken it. Oops, I'm sorry. I've fallen into the trap of the delay on the slides. Pardon me. I've broken it into a component structure of policy, process, and organizational design to start with. From the standpoint of policies, if you think about policies, one of the key takeaways is that not all policies are equal. And I'm going to share with you an example that I had seen, a real-life example of a policy that was thought to be very robust and very effective for an international company. Well, after we kind of looked under the hood, we found that that particular policy was nowhere near as robust as they had envisioned. This was an entity, a large global entity, that had put in place some guidelines around spot transactions for FX. They had pretty much buttoned up all of their FX policies from top to bottom. They thought they had covered all potential contingencies. But after we took a look at the policy structure and started to look at the actual transaction flows that were occurring throughout their global footprint, we found something that was quite alarming. This company had limited the authority for spot transactions in such a way where they had put a dollar limit, a nominal dollar limit on when these transactions needed to be managed through home office versus managed at the local level. They felt that if they had set a small enough level, dollar limit level, they could allow their local entities to transact FX spot purchases and sales, and they would be okay. Well, ultimately, as we started to dig into the volumes associated with this trading activity, we discovered that while the limit of under $100,000 seemed very effective and probably safe for most organizations, in total aggregate volume in a given year, this company was seeing transaction flows in excess of $2 billion. So essentially, they were not negotiating rates for $2 billion of transaction flow across the board. That was a huge opportunity cost to this company. And if you would have changed that policy in such a way that even half of that amount required negotiation and more stringent management through home office, they would have saved literally hundreds of thousands of dollars. So this is just a simple example of the importance of looking at policies and structuring the right framework for policies for the entities that you manage and the entities that you're potentially acquiring. Well, the same applies to process. If you look at the various processes associated with FX management, and you're looking to a company that you're acquiring, it's really important that you break it out into the subcomponents of responsibility. So there are elements of the process that focus on exposure management. There are elements of the process that focus on execution and settlement. There are elements that focus on reporting and perhaps effectiveness testing if it's a FAS 133 compliant company. So all of these processes have to be evaluated very carefully and structured in such a way that they achieve optimal results. And when you get down to organizational design, it's again, there are a variety of directions you can go. It's not always best to structure things in such a way that it's a centralized, kind of core managed process. In some organizations, either the culture or the geographic structure or the nuances about the business make it most effective to apply a decentralized process layout or framework. So all of these things need to be carefully envisioned as you're going through the structured design. Now with that, I believe Andy is going to cover some of the integration challenges.
Hey, thanks, Mike. And just to pick up on that theme around process and understanding the implications of the systems environment that support that, if you could just click forward that one next slide, Mike. There you go.
Yep.
So one of the things that we see, especially right after the acquisition is effected, is it's very difficult for the Treasury team of the acquiring company to get that very quick, rationalized view of exposure. There's typically through the integration or the merger acquisition transaction process, there's been an arm's length relationship. But to Corey's earlier point, you effectively own that exposure the moment that transaction closes. So thinking through in advance on how you want to get after that additional information is really key. And many of our clients have leveraged the cloud-based capabilities of FireApps to go in and capture that information and very quickly coalesce that exposure into an enterprise-wide view so they can begin to understand what is that exposure telling them? Are there new netting opportunities? Are there additional hedging requirements, things of that nature? The other thing that represents itself as a big challenge is the fact that now you've got to start working through and rationalizing very likely different charts of accounts. It's very unlikely that you're going to be able to move them directly into a new into your existing accounting system. That may happen over time, but you've got to adequately look at rationalizing data across very heterogeneous environments. One of the other things that we see is a big challenge is that as you're going through this acquisition and through the integration, you're doing this in a very, very resource-constrained environment. So being smart about thinking about how you're going to lay that path down to capture that rationalized view across the combined enterprises so you can come out of that with a holistic process is very, very important because you're going to not find a lot of people that are going to have time to spend thinking about this right after the acquisition closes. One of the other things that can also be very complicated to deal with, especially if it's in effect a merger of equals, is rethinking your functional currency strategy. I've seen this be a significant challenge where you've got duplication of entities within countries. There's a desire to rationalize that to gain the economies of scale from the acquisition, and you have two fundamentally different functional currency strategies. So laying in a framework that allows you to very quickly coalesce that exposure into a single view and look at the impact of different functional currency strategies can be very important in helping you understand what do you need to do to manage the risk and exposure that's going to come out of that. And then the last thing is, again, to Mike's point, is leveraging a best practices approach on finding out what's what's worked in the acquired company, what's worked in the acquiring company, finding out ways in which you can coalesce that. And I think there's always opportunities to learn from each other through the acquisition process, but you've got to come down to a very unified approach to managing currency risk there, and you've got to really have the discipline to get the business units to align around that. And I think as Joe gets into his piece, he'll talk about how they've laid that foundation. So with that, Mike, why don't you talk about taking all these things into consideration? What do people need to do day one and move through this process and get to a functioning foreign exchange environment after the integration is closed or the acquisition is closed?
Sure, Andy. I'll be happy to. Well, if you think about it, day one of the transaction, really many things have to happen almost simultaneously once the deal closes. These are things that can't necessarily be addressed prior to that closing point. So it's essential that there's a clear, comprehensive plan in place to really define and sequence exactly what needs to happen, what needs to occur, and when it needs to occur. So a very detailed transaction and transition work plan is essential. That's probably the most fundamental and important tool that a Treasury Department has going into this process. Now with that plan, you're going to address several key components. First of all, bank accounts. In managing FX and in managing liquidity and really daily cash flow transactions, you have to have access to banking. So one of the key first steps is to quickly put in place changes to the banking structure that facilitate those day-in, day-out transaction capabilities. Now, in some cases, the parent company or the acquiring company just continues to use its own bank accounts to transact business. In other cases, you're quickly setting up new accounts that transition over authorities to the people at the acquired company. And in some other cases, you're novating or just transferring ownership of one account to another. So you're kind of stepping into the shoes of the acquired company in terms of its banking. So there are a couple of different models you can use to approach this, but the key is you have to have that functional ability to transact business on day one. You have to also have the access to information. You have to have visibility. You have to have the ability to provide reporting. And in many cases, you still have to provide local access to transaction and banking information to the local staff. Now, the second point here is fund settlement of transactions. Now, there's that first step of actually settling the FX trade that was hedging the purchase of the company. So we've already talked about that. But then there's just ongoing settlement of day-in, day-out transaction flows that occur associated with the new business. So again, that's kind of tied hand in hand with bank account management. Whether the fund settlement capabilities are focused on local currency or non-functional currency, you have to have the ability to transact. In certain cases, as again one of the earlier speakers had mentioned, there's a lot going on that first day of the closing, and in some cases it takes a few days to kind of work out all the kinks and to get some of these changes put in place. Well, some companies choose to actually have excess cash on hand to support some of the local operating needs of the acquired business and branches if it's a branch structure. So I've seen this work where companies, the acquiring company would actually position certain currencies in place around the globe at certain operating sites that can be accessed by the local staff to facilitate kind of management of ongoing transactions. You know, they need to pay local vendors or they need to pay staff. Maybe the payroll capabilities have not gone into force yet. All of the formal procedures have not been set in motion, but you still need a way to kind of get over that interim period to continue to do business. So positioning local funding is one way to do that. Now moving on to the next page, there are other considerations that are kind of more permanent, ongoing things that you have to think about. One is whether or not, as you're entering into this transaction, you're going to put in place service agreements. These are agreements where essentially you have contracted with the business you're acquiring from to continue to manage certain aspects of the business. So again, that gets you over some of those early humps or hurdles that some companies might encounter with a transaction. If you're allowing the acquired company to continue to provide certain services, one of those could be FX management, it could be just payroll services or some of these other basic things. Having that service agreement laid out and defined very carefully is key. And then having a process in place to monitor the ongoing performance of that service is also essential. Well, ISDA agreements are another thing that contractually have to be thought through very carefully as you're acquiring a business. You're acquiring an entity, you're going to essentially need to conduct FX trades on behalf of this company. You need to carefully review the ISDA arrangements that they had in place prior to the acquisition. It may be that you can, again, novate these or continue to utilize existing ISDAs and arrangements with trading partners, or you need to potentially go in and totally revise that structure of agreements. But understanding what's at hand, what you have in the inventory of contracts, what the terms are, whether they're single jurisdiction, single currency, or multi-jurisdiction, multi-currency, all of these things have to be inventoried and defined. Oftentimes you can't do this until after the close. And then lastly, looking at the counterparty aspect of managing the business. Well, it could be that the acquired company had a completely different structure in place for transacting business and dealing with its counterparties. You may need to revisit those limitations and guidelines and basically tweak it to conform to the perspective that your company has for risk and management of risk. So at this point, I believe we're moving into a panel discussion, so I'll turn it back over to Andy.
Mike, what I think we're going to do, Joe, Mike and Joe, I think in the interest of time, I think we'll go ahead and transition into Joe's section, and I think we'll pick up some of these panel discussion items on the final panel.
Excellent.
So, Joe, if you're ready,
right.
why don't you introduce, or John, if you want to introduce Joe more formally, and then, Joe, we're very anxious to learn a bit more about your program.
Great. So without further ado, I'd like to introduce Joe Burke, who's the VP and Treasurer at Avnet Corporate Services Group. Joe joined Avnet in 1989 as cash manager and currently holds the title of Vice President and Treasurer. Joe is responsible for global cash management, investments, credit facilities, foreign exchange, interest rate risk management, and corporate insurance. In his 23 years at Avnet, Joe has played a key role in raising liquidity for Avnet in the syndicated bank loan and asset securitization markets and the debt capital markets. He has also added value to Avnet by developing a global treasury function, implementing an interest rate hedging program, and improving Avnet's foreign exchange risk management program. Prior to joining Avnet, Joe spent 5 years in the Treasury Department with American International Group in New York City and 4 years in the Controller's Department with Mutual Benefit Life in Newark, New Jersey. Joe holds a bachelor's degree in business administration from Gettysburg College and an MBA in finance from Adelphi University in New York. He is also a member of the Association for Finance Professionals. Joe, thanks for joining us today, and please do take it away.
Okay, thanks, John. And good morning, everyone. Good afternoon, as the case may be. Let me start with giving a little bit of background on Avnet, who we are and what we do. Avnet's one of the world's largest distributors of electronic components and technology products, including semiconductors, interconnect, passive and electromechanical devices, computer products, hardware, software, and solutions. Avnet plays a vital link in the technology distribution supply chain by connecting the world's leading manufacturers of technology with a very wide, broad base of customers, more than 100,000 customers globally. And we provide them with cost-effective, value-added services and solutions and helping them to lower their total cost of ownership of acquisition of technology products. Avnet's revenues, as the slide shows here, is around $26 billion, 17,000 employees worldwide. We're in over 300 locations around the world, serving customers in over 80 countries. We were founded in 1921. We're headquartered here in Phoenix, Arizona, listed on the New York Stock Exchange for just over 50 years now. And one of the things I'd like to point out is in the since 1991, we've had over 80 acquisitions around the world. So just to give you appreciation of who we are, what we do, and how big we are. As a distributor of technology products, Avnet's balance sheet is highly working capital intensive. A lot of our investments and capital tied up in inventory and receivables. Much of that is foreign sourced in foreign currency. Back in 2001, Avnet adopted a value-based management model in an effort to increase total shareholder return. Instead of focusing on accounting profits, Avnet in turn started to begin its focus on returns on working capital and capital employed as a vehicle to increase total shareholder return. The results you can see here from 2001 to 2011 by aligning a variety of strategies and compensation plans within Avnet in accordance with increasing returns on working capital and capital employed. You can see the results for yourself here. we've made a lot of progress in that regard and continue to make progress. This intense focus on optimizing our working capital and our earns and turns, as well as our receivable performance, has resulted in significant return on capital metrics, as I've mentioned. It's allowed us also to look at acquisitions that meet these return on working capital and capital employed areas of around 15 and 27%, return on working capital of around 27%, return on capital employed of 15%. And as we look at acquisitions, we shoot for targets which are that level or even higher. And so we've had a lot of acquisition activity, and that has helped us accelerate and expand our global footprint. So as you take a look down at the pie charts at the bottom of this slide, it'll give you an appreciation of not only our revenue growth, but the fact that today, or as of fiscal year 2011, compared to fiscal year 2001, a lot of our operating income is derived from outside the U.S. now, obviously creating a lot of considerations for managing risk associated with operating overseas. The successful value-based methodology model has enabled us to generate strong cash flow and invest in growth. Taking a look at the slide here, it'll give you an appreciation of the growth that we've experienced and taken on. Taking a deeper dive into our investment activity for fiscal years 2007 and to 2011, you can get an appreciation for the geographical dispersion of our acquisition activity. This activity has given us the global scale and scope, the global footprint to meet the needs of our customers who also want to be in other areas of the world outside of the U.S. So this will give you an appreciation for the activity just in the last 4 or 5 fiscal years that investments continue, and we continue to go where the growth is. I'm sorry, I double-clicked. 1 second. So our strategy has been to go where the growth is, and as a result, it's created a lot of complex operating and systems issues for us. We have multiple instances of SAP and Oracle and other ERP systems from companies which we acquire. And many of the ERP systems that we acquire are necessary. We need to integrate them into our risk management program. So dealing with all of these multiple source systems, we have a Treasury team of 4 regional Treasury centers, and we're located in Phoenix, Miami, Brussels, and Hong Kong. That's the way Avnet's decided to organize its Treasury operations. And while some companies might find that they like to centralize everything all in one place, our Treasury centers not only manage the foreign exchange risk, but they also manage liquidity, Treasury cash management, other types of services that are required at a local level, and to deal with local regulations and customs and things like that. So we find it's important for us to keep a local touch. At the same time, we make sure that foreign exchange, as well as other types of Treasury activities, are managed in accordance with corporate policy. So echoing what Mike had said before, we do have a single policy that we review annually. The policy for foreign exchange, as an example, requires us to manage all the transactional exposures that are known out there on our balance sheet. Once we know for a particular entity that that's working well, we can also move into anticipated transactional exposures, things that aren't quite yet recorded on our balance sheet, but we know we're in the process of purchasing or selling or procuring inventory. So our M&A strategy, as I said before, has resulted in a lot of complicated issues. Today, we have probably 130 plus entities for whom we're hedging on behalf of in Treasury, and we're a fairly lean organization in the Treasury team. We're 11 people globally spread across those 4 regional Treasury centers. So, you know, echoing what was said before, when acquisitions come at the fast and furious pace sometimes, a lot of people are stressed out and there's a lot of need to coordinate and communicate. Overall, our team does a very good job in doing that. Some of Avnet's foreign exchange program requirements are to support the exposure management process on a frequency as needed. And what I mean by that is, depending on the size of the company that we have, whether it's a newly acquired company or a company that is already in our stable, we will support hedging as frequently as we need to get the results, desired results. And at Avnet, we take a look at our foreign exchange results and our other income line, and we take a look at that versus our cost of hedging, and we evaluate that on a monthly basis as a detective process to see should we be doing anything to improve the process. So again, on the hedge frequency side, we need to take a look at value at risk and the size of the company and the size of the exposures to determine what the frequency is. For some of our entities, it might be a weekly exposure frequency and hedging frequency. It might be daily. One of our other requirements are global visibility with regional responsibility for execution. So there's constant communication among the regional treasury centers and between the treasury centers and corporate as to how progress is being made to improve our foreign exchange risk management program, as well as and especially for acquisitions that are ongoing. There's always something going on in the pipeline of acquisitions, and we always have conversations sometime between the constantly between the time the sales and purchase agreement is signed and the completion in preparing for these acquisitions and making sure the roles and responsibilities are clearly communicated and the process is clearly defined on not only who's going to do what, but what's going to be managed. And then, again, the key requirement is incorporating the new businesses quickly and efficiently. And one of the things probably many of you know is the systems don't get integrated right away. Typically at Avnet, the systems integration of a newly acquired company might take, I don't know, 30, 60, 90 days from the day that we complete the acquisition, and maybe for strategic reasons we keep them separately. That creates its own set of challenges because it, no longer can you or you cannot include those data source into the existing stream that you have, but you need to handle that in a separate basis and try to integrate that into your system. And then the third thing that I'd like to mention is over the years, whether it was designing the existing program we have or working on continuous improvement initiatives, we leverage our operational excellence team, a team of black belts in process improvement, and they help us to ensure that we have an efficient process regarding accounting and exposure definition. It's really important to work in a project environment when looking at some of these larger acquisitions as well as ongoing process improvement to ensure that you have lean processes in place and it's efficient, because one of the things here at Avnet, as I mentioned to you before, is we have a fairly lean staff, and we just can't hire additional employees very often to just because we're acquiring more companies, and that creates a lot of stress and strain, as I said. But if you have a good, efficient program in place, well-defined process, you'll be able to integrate companies efficiently and effectively. So here's the global footprint, or the high-level solution footprint for our exposure risk management program. If I took a look at this 7 years ago, before we got together with our operational excellence team, you'd probably see a bunch of spreadsheets and a telephone. And it really is the truth. Prior to the current solution footprint that we have, which has been in place for about 3 years or so, everything was done manually. And one of the drawbacks of that is, we thought we could do fairly well, but as the acquisitions mounted up, we experienced a lot of what I would call self-inflicted wounds or just manual process errors. And through working with our OpEx team and mapping out the processes involved in foreign exchange, risk management, and acquisitions, we've been able to, create a fairly efficient global footprint for our solution here. On the left-hand side, you'll see all of the ERP source data systems that are generating exposure files based on general ledger totals each day. We get balances that come in to our FireApps cloud-enabled solution. The files come in on a daily basis. Down at the bottom, we have other exposure sources, as you will see. So this is typically where a newly acquired company will come in. As I said, on day one, we do not have them integrated into our SAP systems or Oracle system. On day one, we have to make sure that we have in place process roles and responsibilities communicated and a process in place to capture the exposures of the newly acquired company on day one. Typically, that comes in one of two ways. One is we develop, prior to closing, a process for extracting out of their financial system the tables that we need, and we upload them into FireApps either through an automated transform process or we upload them manually through an Excel spreadsheet. And in that way, on day one, we have the exposures folded into our existing program so we can manage them. There may be hedges outstanding on that day. If they carry over through the acquisition, we'll build them into our system. So again, on day one, we've got the newly acquired company transmitting the exposures into our FireApps foreign exchange risk management solution. In that way, we can combine those exposures of the newly acquired company in with the other exposures for that region. The Treasury team will manage the identification of risk within the FireApps solution. The way that works is basically our files come into the FireApps solution. It goes through a filtering process based on what I would call FAS 52 or the ASC 830 codification rules for revaluation. And basically, we're mirroring the foreign exchange revaluation that goes on in the general ledger or in the financials of our subsidiaries. We're mirroring that in FireApps, producing a exposure file. Treasury is the steward of this process in each region on a global basis. So I know that, if it's Monday in Hong Kong, for example, our Treasury team is running through this process. And then later on in the day in Brussels, the Treasury team there is running through the exact same process. They're taking these files, they're filtering them down to exposure reports, they're analyzing the exposures, and they're preparing them through getting hedge recommendations. On the right-hand side of the screen, you'll see FXall, which is our foreign exchange execution and confirmation cloud-enabled solution. Both FireApps and FXall are available to all Treasury people on a global basis. And I think that's one of the things that I would just mention with this cloud-enabled software. We have people entering into this software or Treasury teams globally, and we've never had a problem having them access it, unlike some other, how shall I say, homegrown systems that we've developed on BW, which sometimes have some compatibility issues with users coming in from Asia or Belgium trying to access it. So the cloud-enabled solutions work very well for us. So what we do, continuing on with our process here, once we have the hedge recommendations prepared, we automatically update them into FXall, where we're getting competitive bids for our foreign exchange. We execute those bids based on the best pricing that we get. We have any relationship bank that we want plugged into FXall. They provide us with our quotes. So we're getting the best rates we can from our relationship banks. And then from there, we're bringing those hedges outstanding back into FireApp so they can be prepared for the next hedge run, the next hedging cycle. Now, the good news for us here is we also have SunGuard as a solution. This is currently being used in Europe, but we're in the process of taking a look at a treasury management system for use by Avnet's Treasury globally. And so the way that works is we believe that a footprint like this for Avnet will be a good solution in which we'll have cloud-enabled technology available for all of Treasury and also for finance teams around the world to come in as they need to. One thing I didn't mention about FireApps is as Treasury is shepherding the exposure management process through, we also give access to the hedge recommendations and the underlying data. We give access to our finance teams around the world to come in and check a box to make sure that they are okay with the data. Perhaps there could be an incorrect accounting entry somewhere in their general ledger that got passed. They have the ability to come back to us and let us know that something might need adjustments in that case. The other good thing about this, between FXall, which has dramatically reduced our cost of hedging, and FireApps, which has enabled us to, on a regional basis, net all of our currency pairs and go to the bank with one net transaction. So we get almost a double benefit there. We're netting all of our currency pairs on a region-by-region basis, and then we're competitively bidding them out in a more competitive way than we were in the old days with the telephone. So we can do the hedge transactions on a net basis, but then FireApps will also separate out that net transaction on a gross basis, so we can do internal trade tickets in Europe with between our in-house bank and each subsidiary. So I know that was a lot to take in, and I'll be happy to take questions at the Q&A session. But just in summary, this solution provides Avnet with a global standard for risk identification and management. It streamlines and automates the data gathering process. It allows us more time to discuss the qualitative issues surrounding our data, and allows us to maybe get more involved in the operational excellence aspect of improving the data that gets fed into the system. This also provides us, you see the corporate treasurer box at the top, that's me, always looking at the data. It gives me real-time visibility into our exposures and value at risk on a entity basis as well as a enterprise-wide basis. And most importantly, it allows for us to quickly integrate newly acquired companies into the Avnet process. Allows us to do that quickly and efficiently. So I think that's my aspect, and I'll just sum it up and I'll hand it over for the panel discussion.
Thank you, Joe. That was a great overview of your program, and I know it's been a heck of an effort to get the program to this level. As you move into the panel discussion here, one of the things I think it'd be great for you to share your experiences with the audience is that whole angle on leveraging the operational excellence team and continuing to ensure that your organization is prepared, especially as you bring in newly acquired entities. Perhaps you could build on some of the themes that Mike was talking about earlier about just making sure the organization is ready to respond as you bring in new acquisitions.
Yeah, I think sure. One of the things that I think is important with acquisitions as well as large projects, we get our operational excellence team involved. A lot of it has to do with change management. and a lot of it has to do with making sure everyone's clear on things like what the definition of foreign currency risk is. You know, in order to do that, it helps to work with a partner who's trained in mapping out processes, looking at the mega processes at a high level, you know, getting these processes mapped out on swim lane charts or process charts. And it really helps to understand what you're doing today and why you're doing it. Our experience was that as we went through this process, just in a general foreign exchange process manner, not related to acquisitions, is a lot of people around the organization, despite our best efforts to communicate and to distribute policy and things like that, a lot of them had a different idea or had a different interpretation of what foreign currency risk was. And they were incorporating that into their daily Excel submissions to Treasury. So I think working with OpEx allows kind of the, how should I say, a helpful partner to you know, explain to others why they need to change, as well as what the results and benefits of that change will be. It helps you to quickly find out what processes are not needed, what processes are needed, and making sure that you have a path to implement those.
That's great, Joe. I think I'm a big fan of that, having done quite a bit of time in the lean manufacturing space. Corey, I know one of the things that you look at as across our client base is as companies go through the acquisition process, there's a lot of things that they need to think about continuously. Rate conventions, the ways in which the rules are set up for defining the exposures. There can be wild inconsistencies across that. Perhaps you could touch on a few points on things that you think people should be thinking about and how they should take those issues on, and what are the implications from a volatility standpoint if they don't.
Okay. No, thanks, Andy. And I'll build on some of the things that Joe touched on along the way. In the first one, it's when you start to think about rationalizing rate conventions, and a lot of times the rate convention associated with a how rates are updated in the ERP system, a lot of times will drive the methodology, the exposure management methodology. So if suppose there's daily rates or weekly rates being fed into the system, companies will lean more towards managing their exposure off of actual data. If they have a single rate environment and rates are only uploaded once a month, then they tend to lean towards trying to forecast the end-of-month balances associated with the exposure and build their program off of that, and being focused on actual to forecast errors along the way in managing their program. So as you begin, depending on what as the enterprise grows and the system environment grows, then it becomes rationalizing those rate conventions and the processes that sit behind them. And that comes right down into standardizing the exposure definition processes and rules also. It is that if I've got some of my process that in the acquiring company that's based on actual, I've got the other process in the acquired company that's being based on forecasts, am I going to look to standardizing the rate convention in one of the systems versus the other? Or are we going to manage them jointly through the integration process and rationalization of the systems? How do those play? How do those play together? And also Joe touched on the remeasurement rules and FAS 52 and rationalizing and normalizing those, and being able to look at the chart of account structure and being able to get at the entity GL account structure that's there so that you can test and take a look at the remeasurement environment there for initial configuration, because that ultimately will drive the exposures that you're reviewing, and then ultimately looking at it from a maintenance standpoint and a monitoring standpoint. Is that system changing? Is that environment changing as that acquired system is marching towards integration by the acquiring company? So keeping that visibility and keeping those system and process and monitoring in lockstep, because ultimately at the end of the day, it's all about reducing the P&L risk associated with FX. what the program goals are and what the strategy is. So moving those together. And the last point, it's about synchronizing that exposure management and hedging cycles. What is the best process? What are Joe mentioned, it's working through a change management and process improvement processes and figuring out what is the best overall process to reach the ultimate goal that you have in place.
Thanks, Corey. Mike, I'm gonna give you kind of a last word here because we are running up on the end of the hour or end of the allotted time here. But Mike, perhaps you could, taking Joe's reference case study here as kind of a backdrop, perhaps as you look across your client base and other companies that you worked with, I'd love for your comments on sort of the leveraging of this cloud-based approach on gaining these synergies from the M&A transactions, and also your final thoughts on just making sure organizations are really dialed in and ready to move through an acquisition as risk-free as they possibly can from a currency standpoint.
Yeah, no, I think the case study nicely portrayed how you apply technology most effectively to really integrate an effective framework of risk management. The Avnet example, I think, really portrayed the perfect combination of best-of-breed technologies that can quickly be brought to bear to move into an acquiring structure and integrate effectively into all of these existing processes in a very efficient and cost-effective way. So I was really impressed by the example. I would go back to my points earlier about planning. As you look through all of this, each step in the process of going through the acquisition, it all really boils down to a framework of effective planning. And the planning begins at the early stages of evaluating the target for acquisition and starting to think through all of the elements and components of a successful transaction. And as you're framing that from the standpoint of FX and risk management, there are so many components to consider, and a detailed, very well thought through plan will enable you to consider all of these things in a very structured way. So that, if I could leave any kind of advice behind from this webinar to the attendees, it's do not underemphasize that planning process. That's where you can end up with these well-structured technology frameworks and best practice scenarios that the speakers have shared with you today through detailed planning.
Thank you, Mike. John, I'm going to turn it back over to you, and you can take us through some closing thoughts, and if we still have some time, some quick Q&A.
Great. Thank you so much. And that was a great discussion right there. So let's get to the closing thoughts first. First off, without a doubt, the euro-fueled uncertainty is here to stay. This has taken us a lot farther down the road than I think people anticipated when this first reared its head, and there are no signs whatsoever that it's abating or that it's going to become less of a problem anywhere in the near to midterm. So these are issues that we all need to figure out how to deal with in our own finance and treasury operations. Next, effective FX risk management protects M&A returns. There's no doubt about that. Occasionally, M&A transactions are done across borders for reasons other than a very specifically planned and approved goal for returns, but usually that's not the case. And if you want to be hitting your targets, you have to be on top of your FX risk management, or else you're not going to be meeting your M&A goals. Companies of all sizes are adopting FX exposure management and best practices in M&A. If you're big enough to do M&A, this is probably going to be, cross borders especially, this is going to be a key issue for you. It doesn't matter whether you're a $100 million or a $10 billion company, you do have to figure out how you're going to deal with these issues. It's going to be a combination of people, process, technology. and you'll want to make sure you're aligned with the right partners and folks who have done this before. There is no doubt that companies that are making cross-border transactions today that are smaller than ever before. That used to be only the purview of the largest global companies, but now almost everyone is a global company. So we all need to prepare for this and consider this in our forward-looking planning, and have a plan and execute on that plan so that we're ready in our organizations to have successful cross-border M&A transactions. A fundamental part of M&A program success is analytics. If you can't measure it, it's hard to do, or it's certainly hard to know how you did. You need an analytics platform that allows you access, quick and ready access, as Joe mentioned, available across the organization and readily available, so that everyone understands what the playbook is, what the current information is, how we're doing against projections and current days movements. This is all critical, and if you don't have the information, you are driving without a roadmap. So I think that analytics are fundamental and more important than ever, especially in today's rapidly changing environment. And finally, enterprise collaboration is key to these efforts. It's amazing, Joe, how small your your Treasury organization is, considering A, how large your enterprise is, and B, how acquisitive you are. And you can't get there without working together across time zones, across borders, certainly across currencies. That is absolutely key. Without that, this probably isn't going to work or isn't going to work well for you. So that wraps up our prepared content for today. We do have a couple of quick items we'll take care of, and then we'll see if we can get to a question or two here. We've got a whole bunch of them stacked up. But quickly, let's get to a polling question, the final polling question. This is the third of three. I'm launching it right now. Please take just a moment to answer this. If we don't get to your question today, then we'll do our best to work with the speakers to get answers to you post the events. Once again, even if you are not here for CPE credit, we would appreciate you taking about 10 seconds to answer this question. And the first thing we're going to do is actually turn these questions around, show them to the audience, and ask the panel to weigh in. So we'll leave this out for another 5 seconds or so. And let's go ahead at this point and move on to Q&A. We do like to start this by showing the results of the polls from today. So we're going to go back to our first polling question and revisit that. How would you characterize your company's concern over the future of the euro? Less than 10% have no concern at all, 22% neutral, and then we've got 70% somewhat and very concerned. Mike, as you're talking to clients around the world, what's your take on where companies sit regarding the future of the euro?
Yeah, it's funny. I've had several discussions over the past week or two as things in Greece were heating up. And, you know, companies are taking very different approaches depending upon the size of their organization and the culture of the organization and the perspective of senior management. Some organizations are really kind of standing back and kind of taking a wait-and-see attitude. Others have treated this much like they would a disaster recovery contingency planning exercise, where they have looked through every detail and every potential scenario and developed workarounds for each and every event that could arise. But for the most part, I think what you can take away is that almost all organizations are viewing this very seriously. They are very concerned with counterparty exposure, FX exposure. They are, in almost all cases, having ongoing discussions with the C-level of the organization about contingency plans. So it's, you know, it's interesting. It's an issue that can impact most every organization, and if not directly in their business interactions in Europe, then directly through their banking network.
Thanks, Mike. And you bring up a good point. I think everyone has considered this, but Corey, I'm going to ask you the next question. Is there any boy who cried wolf syndrome going on here? This euro disaster, you know, it's like the sky is falling every month, and that's been going on for a lot of months now. what advice would you give to companies who are sitting here waiting for, some shoe to drop?
I would say that, echoing back to some of Mike's comments, it's an awareness. It is I'm seeing companies along the lines of 70 Cent being concerned or being able to look at contingency plans. But I think it's a true risk that's out there. With the German Constitutional Court yesterday, there's a number of key things that are out there that are causing a risk. So the companies I'm working with today, they're all over the board in doing that. But I think all of them are thinking of it as it is a true risk. And what should they be doing to potentially reduce that risk? I worked with one this week that said, you know what, I want to sweep as many of my euros out of my countries, the countries that I can, and convert it to dollars and Swedish and sterling, just until we get through some of the key things here in the next few weeks, and then we'll continue to assess. But they're beginning to put in euro risk management, more stringent and programmatic euro risk management programs.
Yep. And Joe, quickly over to you on this. How much are you hearing about this from up the chain? CFO, CEO, the board, how much attention are they paying to this, and how are you feeling that in your treasury operations?
At the C level, they are aware, and I guess classify them as somewhat concerned, but they're confident that the team that we have that operates not just Treasury but the finance team globally can take steps to mitigate the risk. There's only so much we can do. Today we are not going through a lot of steps to repatriate funds in any unusual way. We're kind of keeping business as usual, but being aware of what our counterparty risk and our country risk is, and those two things in particular.
Okay, great. Thank you. Now, we have just a couple minutes left. I'm actually going to zip through these next two poll results. So of the folks we have on the phone today, it's 80-20 splits, 20 being that their companies are considering closing on an international acquisition in the next 12 to 18 months. And then sort of related to that was our last polling question, which I'm loading up right now. And here we go. Our company's currency risk management program is well suited to integrate new acquisitions. So about a third say yes, 20% say no, 49% not applicable. That's probably most of those folks who aren't planning on acquisition. But certainly there's work to be done, and as I've seen in my 4 tours as a CFO, this is an area of great concern for a lot of companies, and something that I'm sure we'll be continuing to hear a lot more about in the future. And now we want to be respectful of everyone's time, both on the panel and the audience. So why don't we at this point go ahead and hop into the closing statements here. The first of which has to be a great thanks out to all of the folks on our panel. Thanks so much today to Mike, Corey, Andrew, Joe Burke. Great job today, folks. Just a lot of fantastic information delivered very well, and really I feel like we've brought the audience well up to speed on foreign currency translation issues, risks, best practices when it comes to M&A and its impact thereon. So thanks so much today, gentlemen, for your time and attention.
Thank you.
Thank you, John.
Thanks. Appreciate it.
You bet. And next up, a couple of other quick items to learn more. You can find these resources which point to prior events and resources that we have online at performative.com, including past webinars, which we have recorded. This, as a reminder, this deck is downloadable right now at performative.com/resources, and we will also send a copy of that out to you. Actually, not a copy, a link to a copy via email, so everyone will have access to that. Oops, I think I still had the last poll result up, so sorry about that. This page here, to learn more, will be coming your way. You'll be able to quickly access and download more resources via performative.com. Finally, if you have any questions at all about CPE credit, please contact Tanya Walsh. You can see her email right there. And a thanks, of course, to Fire Apps. Everything we do at Performative, all the education, all the events, the online platform, everything is free, freely available to everyone who needs to use it. And it's through the generous support of folks like Fire Apps that is possible. Obviously, they are also steeped in today's subject matter. So if you would like to follow up with either of today's Fire Apps speakers, Corey Edens or Andrew Gage, or the other speakers, Michael Ellis of Treasury Strategies or Joe Burke, please take 60 seconds, fill out the survey that you're about to be hit with, and we make it very easy, just a click of a mouse. And we will be more than happy to connect you with the speakers on today's webinar. So with that, I thank everyone for your valuable time and attention today. We greatly appreciate it. We hope to see you at another Performative event or online at performative.com. And with that, have a great rest of the week, everyone, and we'll see you next time.